Hi, welcome to today's video and thanks for joining me. Today we're going to be talking about this subject, an RRSP meltdown with 3 rental properties saving $670,000 in taxes. Whew, I was really stoked about this plan, really happy to deliver it to my clients because they were feeling like retirement was going to be a very, very dismal situation for them. They actually felt like they might have to live in their basement, like make a unit in their basement and rent out the top floor. And so happy to tell them they didn't have to do that, that I have transformed their retirement, gave them great news. Now they're thinking about what other things they can do. So today I'm going to share with you, how did we save the $670,000? Everything, the CBP optimization, old age security, RSP meltdown, RIF meltdown. What did we do with the rental properties? We sold a property and transferred a property to a son. So you're all asking me, can we transfer properties to our kids? Yes, you can. You just got to pay the capital gains. I'm going to show you how we dealt with all of that in this one video. Wow, this is a lot in this video. You're going to really like this. If you got rental properties, you're going to love this. If you don't, it's okay. Pay attention to the CPP optimization and old age security and the RSP meltdown. This is what you all want. Okay, it wasn't just $670,000. Wow, it was no planning, $1.1 million they're going to pay in taxes. With planning, $430,000. That's saving them $670,000 in estate taxes. We also increased their government benefits, so CPP and old age security, by $421,000. And we saved $104,000 from being clawed back of their old age security. That's a lot. Like, totally happy with this plan. And so are the clients. They're just didn't think it was possible. And not only was it possible, we did all these things for them. So how did we do it? Let's dig in it. Hey, also remember to put your comments below. Remember, I'm the person who is responding to your comments, not somebody else. So when you get that reply, you know it's coming from me. Let's go into the planning pages and I'll show you what we did. All right, now you're looking at the planning pages for William and Catherine, my favorite YouTube couple. I'm going to walk you through everything that we did. I know for some of you who are watching these videos for the first time, you're looking at this and it looks like an Excel spreadsheet, which is useful because a lot of people are used to Excel spreadsheets. But don't be too worried because I'm going to walk you through very easily what all of these things mean, and then you'll be able to understand how we help them. So you can see here that William and Catherine are 67 and 63. William's already retired. He's started his CPP and old age security long ago. And Catherine has a couple more years to work, and then they're going to begin their retirement. They want to spend about $79,000 per year, and that's after tax. So what does that $79,000 mean? That's spending $79,000 on utilities, property tax, buying groceries, buying clothes, date night, putting gas in the car, like your regular lifestyle expenses, but doesn't include any payments to the tax-free savings account. It doesn't include any debt payments, doesn't include travel. This is in addition to all that. So that $79,000 is really about just right in your own home. What does it cost for you to be in your own home? Now, on top of that, they're going to spend $12,000 in travel. Now, also something about plans I wanted to draw your attention to. If you're getting a plan done, usually, let's say you go to the bank and you get a plan done for them, the biggest difference here between what they might do at a bank and what we're doing here is the detail that we put into these plans. You can see when you look at the travel column here, $12,000 they want to spend now. Then they go, you know what, we're not going to go and spend a lot the next year because the following year we're going to spend $25,000. Then 15, then 13, and then adjusted for inflation. So you can see the details, the nuance here that we're able to provide you when we're doing a plan. Why is this important? Because when you put an expense like that, that money's got to come from somewhere to pay for that. So we want to be able to tell you, when you do these kinds of expenses, this is the kind of strain that it puts on your investment accounts to provide that income. And let's figure out, is that going to be a problem? Is that going to increase your tax base? Is it going to deplete your asset faster? And we can help you to figure out how to pay for those things without making it a problem in your life. So that's why we put these detail in your plan. So how do you read this? $79,000 for your after-tax spending, plus the $25,000 for the trip, helping the kids out with some education, going to replace a car at some point, going to do the renovations that they thought was going to be to build a rental unit in their house. So that's where they would retire and rent out the main floor. Don't have to do that now, so I'm so happy about that. We've got some rental income coming in. So I'm going to slide over now to show you so expenses and some rental income. I'm going to slide over and show you where we're starting off. We are starting off with 1.4 million in assets. You'd think, well, that's got to be enough for a couple at age 63 and 65. But if you're thinking that, if you put your mind into someone who's got rental properties and you're paying rent and you've got expenses and you're worried about whether or not that's going to be sustainable over your lifetime, and you're thinking about how much money are you going to burn through, especially when you have some other expenses you want to take care of, this is a concern, right? So I'm going to show you exactly how we help this couple out. So let's dig into the first thing. You can see here the rental property 3. This one is owned by Elizabeth, or Catherine. The royal names I like to use, right? So Catherine has a property that she's going to sell. And there's the 800. I'm going to make this a little bit bigger for you. There you go. So $877,000 rental property we're going to sell in 2 more years. And we're going to pay that rental property off. So there's the debt on the rental property. We're going to retire that debt. And then whatever's left over is going to go into their TFSA and the non-registered account. So let me show you that so you can see exactly where that money is going. So I'm going to dig into here to Catherine's planning page, and we're going to slide across, and you're going to see there is the $870,000 rental property. There's the debt being paid off. So where's the money going? So we slide across here and we say, well, we've got some money going into a non-registered account. We have some money going in, money going to be put into her husband's TFSA and to her TFSA, and all they had available was annual limits, so that's all we can put in there. But because she's going to have to pay a capital gain on that rental property, we're making a $171,000 RSP contribution to offset the tax rate. Tax rate was much higher here, and now because of the contribution to our RSP, we've lowered the tax. So that's how we accomplished lowering her tax on the rental property, number 1. Now, she wants to also transfer one of the properties to her son. Now, it's not a condo that's worth $478,000. When you have rental properties or when you have any other properties, they might be owned personally by one spouse or by joint, right? So this is a joint property, so times this value by 2, that's the real total value. But we just split, because it's a joint property, we assign 50% to one spouse, 50% to the other. So that's what you're seeing here in all the properties and the home as well. So we're selling the property. We're paying the small mortgage off, the $81,000. We're not actually selling the property. We're transferring the property to the son. And when you transfer the property to the son, you have to pay the capital gain. So we're paying the capital gain. We're retiring the debt. And we are also, if you look here, beginning the RSP meltdown. So let's dig into how that works, because this is the second part of sort of the tax strategy along. You want to have no money left in your RIF, right, when you pass away. So one of the conditions that this couple said is we want the RIF retired by age 82, age 83. So you can see here, that's 82 for Catherine. So we're trying to be mindful when we do an RSP meltdown of the tax rate. You see this effective tax rate right here? It's always about 19%. We don't want to have spikes, right? We want to flatten that tax rate out. So as we're doing withdrawals, you can see some years there's 30,000, then 50, 60, and 70,000 and 85. You can see that their rates are not always the same as we go through, because we see that if we take out more or less, the tax rate is going higher. So we're trying to flatten that out. The other thing too is, because of that 1 year where we're doing a sale of the property, Catherine is going to have a higher tax rate. So we're not going to take money. We're going to suspend the RSP meltdown for that 1 year, because look at the tax rate, 27.86%. If I took more money out there for her, that would just bump up her tax rate. So we don't need to do that. We can just wait 1 year and continue the RSP meltdown, and we've got it all tied up inside of age 82. We're making contributions to her TFSA all throughout her lifetime, and then we're dipping into non-registered accounts. Sometimes we're making deposits, sometimes they're making withdrawals. So that's how that's working. Never having to sell their home in retirement. They get to stay in their home throughout the retirement. So another conversation would be, well, are you going to live in your home until age 85, 90 years of age, or are you going to want to sell that and move into another place? If you go into William, Same thing with William. Is slide across here and we say here is William's RRSP meltdown, being mindful of the tax rate. Again, there's that one tax hit where we had a tax hit for him, but there's your 19%, basically the same tax rate. There's the TFSA contributions throughout their entire life, and again, diving in and out of their non-registered account to help them with their lifestyle choices. This is how we help this couple save so much money. There's an RSP meltdown, there's CPP optimization. Catherine, we push CPP off to age 70 to help us with the RSP meltdown. We're doing maximum contributions to their tax-free savings account throughout their lifetime. We're being mindful of the tax rate when we're doing the withdrawal on their RSPs. And we've also accommodated their request of wanting to sell one property and transfer one property to the son, and how we were able to do that. That was a massive savings across the board in almost every category that helped them. And more importantly, answered the two big questions. Are we going to be able to retire with enough money, because we feel like we're not going to be able to? So got that out of the way. First call, by the way, the first Zoom call we had after getting their information was, you're going to be able to stay in your home. You're not going to have to build an apartment in the basement. You don't have to do that. You can live in your entire house and fix the basement up the way you like. So that happens right away in the first call, guys. When you book an appointment with us and we do this for you, the big answers are happening in the first meeting. We're not going to stretch out 3 or 4 planning meetings and not be able to give you these examples or answers and have you worried trying to do planning with me and being worried and having anxiety along the way. No way. We're answering the biggest questions right away in the first Zoom meeting with you. It's so important. Well, what did you think of this video? I hope you enjoyed it. What did you think of the strategies that we use to help this couple? What are the strategies that you're using in your plan? Now, I'll say this one thing to you. You all know that when you go onto my website and you see the cost for doing these plans are $3,000 for a household and $5,000 for a corporation. And it's not both. If you're a corporation, you're not paying both. It's just one for a corporation. You get the household plan. $3,000 this couple invested into doing a plan, and they saved $670,000 in estate taxes, $421,000 in government benefits that they got more, and over $100,000 in old age security clawback that we had totally avoided, all for the $3,000. So it's money well spent, I think, right? I think you would agree. Well, thanks for tuning in today's video, and I look forward to seeing you in the next video. Thanks and be well.